Big news in the crypto world. The SEC just approved the first ever multi-asset crypto ETF. This includes XRP, Solana, and Stellar alongside Bitcoin and Ethereum. For altcoins, this could be the moment everything changes. Welcome to Plugged In Crypto, where we break down the biggest shifts in the market without the noise. On the 25th of September 2025, the SEC approved the Hashdex Nasdaq Crypto Index US ETF, or NCIQ. This is historic because it allows a US-listed ETF to hold not just Bitcoin and Ethereum, but also XRP, Solana, and Stellar Lumens. This approval came under new standards that let issuers apply more quickly for crypto products tied to recognized indexes. Instead of years of litigation, the process took just months. The market reacted sharply, with XRP and Solana jumping 5 to 8% within hours. Trading volumes across altcoins spiked, and retail traders are buzzing about alt season again. Analysts estimate this ETF could open the door to billions in inflows, expanding the investable universe beyond just Bitcoin and Ethereum. For years, US investors had limited options for crypto exposure, but now Wall Street is giving a stamp of approval to a broader basket. ETFs are the preferred gateway for institutional money. They're liquid, regulated, and easy to slot into retirement accounts. The Bitcoin ETF proved this point, absorbing tens of billions in assets within 6 months of approval. Ethereum's ETF followed suit, pulling in over $2 billion in its first weeks. By approving a multi-asset product, the SEC has ended the monopoly of only 2 coins are safe. XRP, Solana, and Stellar now sit under the same regulatory umbrella, signaling a major shift. This comes at a politically charged moment, with the Trump administration leaning toward pro-crypto rhetoric. The SEC is now positioning itself as an enabler, flipping the script from regulation by enforcement to regulation by integration. Canada launched multi-asset crypto ETFs back in 2022, and they functioned normally, attracting institutional money. The US is finally signaling that altcoin exposure is becoming mainstream financial infrastructure. This matters because retirement accounts hold enormous amounts of capital, roughly $9.3 trillion in 401k plans alone. Even a small allocation could unleash tens of billions in fresh demand for XRP, Solana, and Stellar. These networks have established user bases but limited access to regulated capital, and ETFs can solve that bottleneck. What happens next? One possibility is that inflows surge, expanding liquidity in these altcoins dramatically. Prices would likely benefit, and volatility could stabilize as institutional holders replace short-term speculators. Another scenario is that competitive products race to market, with other issuers like BlackRock and Fidelity filing for their own multi-asset ETFs. This competition could accelerate adoption and push into other coins like Cardano and Avalanche. But caution is key. Wall Street has a way of extracting value, and ETFs come with layers of complexity. Coins might sit locked away while firms issue shares against them, collecting fees instead of flowing into real on-chain usage. Regulatory risks remain, and just because the SEC approved this doesn't mean the risk is gone. Remember, XRP fought a long legal battle with the SEC, and old wounds can reopen. Globally, Kazakhstan just launched a Solana-based stablecoin, and Asia is pushing adoption through super apps. The ETF approval may be just one piece of a global pattern, regulated rails converging on crypto. So, the SEC has approved the first US multi-asset ETF, giving Ripple, Solana, and Stellar the same legitimacy as Bitcoin and Ethereum. Billions in potential inflows could shift how altcoins are valued. But Wall Street's involvement means fees and risks. This is a breakthrough, but not a free pass. Altcoins have entered the mainstream stage, bringing both opportunity and control. Make sure to subscribe to Plugged In Crypto and stay plugged in.